Today we're busting the top 10 write-offs the IRS loves to nuke, the ones your buddy swears his barber's cousin CPA allows. Right? I'll give you the rule, the code, the receipt, and the legal fix so you can keep more and sleep better. Let's just jump in. For starters, let's go over the code provisions. As you guys probably know, the Internal Revenue Code is a rule book that is interpreted by the regs. Then come publications and revenue procedures. And finally, we get courts interpreting all of the aforementioned, right? Everything above. The Internal Revenue Code provisions that are most relevant to what I'm going to be going over today are Section 162, 274, and 262. These are the fundamental rules that we must navigate when claiming business expense deductions. For example, Section 162, is it ordinary and necessary for my trade? This sets the basic requirements for deducting business expenses. Is it ordinary? An ordinary expense is one that is common and accepted in your trade or business. It does not have to occur frequently, but it must be a normal business practice. It must be necessary. A necessary expense, one that is helpful and appropriate for your business. It does not need to be indispensable to be considered necessary, but it has to be for your trade. So the expense must be paid or incurred while carrying on your trade or business, right? An activity must be regular and continuous and have a primary purpose of making a profit for it to be deductible under 162. Next, we go to Internal Revenue Code provision 274. Can I prove it? Do I have a receipt, a log, the who, what, where, when, and why? And this imposes stricter substantiation requirements for certain expenses, overriding the ability to estimate a deduction. Like, you got to show this is what it is. If you don't meet these requirements, the deduction will be it's done entirely. And this applies to expenses, especially things like travel, lodging, transportation, and meals while away from home. Listed property, which is entertainment property, like vehicles, boats, RVs, anything that's generally used for recreation, entertainment, or amusement. It also includes computers and peripherals unless used in a home office. That's a big one. Business gifts, which is things you give to your business contacts. Entertainment, by the way, the Tax Cut and Jobs Act eliminated deductions for most entertainment expenses, but things like meals are still generally 50% deductible if they're not lavish and the taxpayer or employee is present. In other words, I can't just pay for meals for somebody else. To substantiate these expenses, you must document specific details with adequate records, such as the amount, the cost of the expense, the time and place, which is the date and location of the expense, the business purpose, the reason the expense and the business gained or benefited from that expense, business relationship, the names of the people entertained or who received whatever the gift is. You got to put this in. And then you go to 262, and this is the one that nukes a lot of people. Is any part of this personal? This is the ultimate restriction on business deductions. It states that no deduction is allowed for personal, living, or family expenses. Goner's the guy who says you can write off your Rolex, right? No, you can't. I can write off my suit. No, you can't. The IRS will scrutinize any expense that has a personal element to it, such as travel, meals, vehicles. You can't be going around riding in your Ferrari saying, oh, this is a business write-off. For example, while you can deduct the cost of a business trip, you cannot deduct the cost of like a personal side trip. So if an expense has both personal and business use, you can only deduct the portion that is strictly business related. Commuting costs, for example, are considered personal. They are not deductible unless, this is where guys like me make their living, you set up a home office and you're commuting between business locations. Now it's a business expense. So weird stuff like that. So let's go over the top 10 most tried non-deduction stuff you just get hammered on, right? Number 1, personal travel labeled as business, right? And here's the myth. If I talk business on vacation, it's deductible. Go look at a couple of properties, you can write everything off. No, the trip must be primarily for business, and every expense must meet the ordinary, necessary, plus substantiation requirements, 162 and 274. Spouse and kids are not deductible unless they're bona fide employees with real duties. What codes are on here? 162, business travel. 274, substantiation. 274, spousal and dependent travel is also covered. The fix, make sure you have a business first itinerary. You have agendas, receipts. If the spouse works, make sure they have actual payroll, a defined role, and documentation. And let me give you an example of something that actually works. Let's say, and we used to do this, we would have what we call executive retreats. We'd have them in really great locations like Hawaii. We would do Thursday, Friday, Monday, Tuesday events, and they would be a minimum of 4 hours on each of those days. So it was primarily for business. Well, guess what? You have a business day on Thursday and Friday and Monday and Tuesday. And because it bookends weekends, the tax code says you can add those 2 days too. So you have 6 days that are business. You get a travel day on either side of that. You could have 8 business days. So if I stayed longer, I'm in Hawaii, I want to stay 4 extra days. Can I write those off? No, you cannot. I can write off my entire travel costs, so my plane tickets I can write off, and I can write off the days that I was there for business, so my hotel, meals, and things like that I could do. But once I'm on personal, done. And people screw this up all the time. They think, oh, if I just say it's business, it is. It doesn't work that way. Number 2, wellness, vitamins, and supplements without a diagnosis. You just start buying all this stuff, you do some wellness, and the myth is, wellness helps me work, so I can write it off. No. General health is personal. Can't write it off. 262. Gym dues, vitamins, wellness plans don't qualify unless it's tied to a diagnosed medical condition and you're under medical care. What are the code provisions? Well, in this one, it is 213, medical care, 262, personal. What's the fix? I always tell people use health reimbursement plans, health savings plan, and use it correctly for things where somebody is actually diagnosed and prescribed it. So make sure your doctor. Supplements, therapy, only with a physician's diagnosis, and there has to be a medical necessity, and you have documentation. Then you could start writing those off of like your HSA, your health reimbursement plan if you have a C Corp. And by the way, if you are trying to write things off individually, I'm just going to give you a free nugget. So a lot of people say, oh, I can write off my medical expenses and I can write it off under Schedule A of my 1040. It has to exceed 7.5% of your adjusted gross income. You then add it to things like your mortgage deduction, your state and local taxes, and my charitable giving. And if it exceeds the standard deduction, which this year is $15,000 for an individual, $30,000 for married filing jointly, then you finally get a write-off for it. But here's the rub: about 40% of the people do not exceed the standard deduction. So 90% of the people don't get any benefit. But if you put money in an HSA, then you can. I can deduct the money I put into an HSA. Again, this year, I think we're around 4,000 individually. Families is around a little over 8,000. And then I use it to reimburse non-covered medical expenses. So long as it's medical, then I could write that off. So there's an easy one. Number 3, though, let's keep going on to the stuff they nuke. Can't write these things off, right? Clothes, jewelry, stuff for your appearance, like your hair, nails, and cosmetics. No. But you say, but I need to look sharp for my client so I can deduct it. No. If it's suitable for everyday wear, it's personal, even if you only wear it to work. Jewelry and grooming are very inherently personal. What are the code provisions? It's 162 versus 262. It's this stuff we went over right in the beginning. Now, there is certain things that you could write off, but they have to be specifically. And this is, I'm getting into like things like clothes, right? You can't write off the clothes. Like I could wear this jacket. I'm doing videos. I'm doing this. I get to write off my suit. No, you can't. Because I could wear this jacket outside of here. Stuff that I can't, uniforms, safety gear, that is not suitable for streetwear. Like a branded uniform, your scrubs, your steel toe boots, those things I could write off because they're not suitable for personal. They're work related. And it has to be for your work, right? I can't just say, hey, I'm a lawyer. I got my steel toe boots. I'm going to write them off. It's not necessary. It's not ordinary necessary for my trade or business. Unless you're a lawyer who's out kicking so much, but he needs steel toe. But no, it's not a thing. Number 4, entertainment. Things like golf, right? This is the myth. Hey, I'm taking my client to golf and I'm taking them to a game and it's business related, so I should write it off. No, entertainment is non-deductible. The Tax Cut and Jobs Act literally nuked those. They're gone. Code provisions, 274. Entertainment is disallowed, 274. Meals have limits, 274. Substantiation requirements. The fix, you got to separate out the meals, which are generally 50% deductible, so long as you have a business purpose and you're present and you document it. So, again, you got to make sure that you're separating this out. How about my golf fees? No. A meal at the clubhouse with the proper business purpose, maybe 50%. The golf, 0%. How about number 5? Streaming, your kids, camps, sports, tuition. And when I say it, I'm going to throw all these things in here. So your streaming might be Netflix, Tubi, there's Paramount Plus, there's all these different streaming services, Max, all that stuff. No, you don't get to write that out. So it's not marketing research, that's personal. How about the summer camp for the kids? It helps them build leadership, so it must be deductible. No, it's personal. So the reality is it's personal. It's tuition for your child. It's personal. Now, if it's tuition, they're learning books for your business, or they're learning something for your business, that might be deductible. Remember, it has to be ordinary, necessary for that particular trade or business. But if it's creating a new skill, non-deductible. What are the code provisions? 262, which is charitable education rules don't really apply here because it's personal. The fix, if the content is clearly and primarily used for the business. So for example, I could see possibly like Netflix for a video production company licensing content. I could see that being deductible. You could document it, but expect scrutiny. You need to be able to show this is not a personal expense, but that it is an ordinary and necessary expense for your trade or business. If you're just a lawyer, accountant, salesperson, you have a pizza shop, probably not, unless you're providing it for your patrons, then you might be able to get a streaming service. But if it's for me, no. Like I'm just trying to, hey, I just want to write off my personal Netflix that I use at home. No. Number 6, pet expenses. Boy, we see this, right? I have a guard cat or I got my chief morale officer, right? And there's a myth out there. People think of this stuff. Oh, I'm going to call my dog, my Chihuahua guard dog and write it off, right? No. It's almost always personal. A true guard dog can be deductible, but only, remember, ordinary and necessary for your trade or business, right? And it has to be reasonably documented. What are the code provisions? 162 and 262, right? And how do you fix this? You got to document your purpose, placement, and proportion, right? Service animals, if you get a medical like you get a prescription for one. So your doctor says you need a service animal. Then it may be medical under 213 with proper documentation. So service animals can qualify for tax deductions if they help you with a specific disability or impairment. But emotional support animals that provide comfort but lack specific training do not qualify for a tax deduction. You can deduct food expenses, veterinary care, and more if your pet does nothing else otherwise. Right? So your guard cat's not going to work. Your emotional support animal's not going to work unless it's prescribed by a doctor, right? Then we cross over. But it's not an ordinary necessary business expense for your business. I'm sorry. Number 7, commuting, vehicle payments, things like car washes, gassing up, everything not deductible for the most case, unless you could show it is business related. So here's the myth. Every mile I drive while talking to a client is deductible. I mean, I wish I had a nickel every time somebody was trying this stuff with us, right? It does not work. Reality, that doesn't matter. Also reality, if I am traveling between my home and a regular workplace, it's personal. I don't care whether I'm talking to business people the entire way. The payments, repairs are only deductible to the extent there is business use, and you got to be very careful about how you choose it and tracking it. I tend to do the mileage back because I don't want to, like, it has to be primarily used for business, right? So if I want to write off a car for my business, we always see this. Buy the G-Wagon at the end of the year. You got to be more than 50%. You can only write it off to the extent it's business use. And if it falls below the 50%, you have recapture rules that just destroy you. So I tend to do mileage, reimburse, it's like 70 cents a mile. And then I don't have to track all that stuff. I'm not writing off my car washes. I'm not writing off my gas. I'm just writing off, here's a reimbursement, and it's only on the business use. Things like car washes on your personal vehicle, sorry, that is personal. Unless you can properly allocate it directly to some business use. And what are the code provisions that we hit on this? There's 1-262, which is a reg. It has to do with commuting. Now, when can you get over that, by the way, is if I'm traveling between business offices. So I have an administrative office in my home, and I have another location, like you're a realtor. If you have a home office and you're traveling to do anything with your clients or traveling to another office, that is a business expense now. That's business miles. I'd still, unless you're using that car almost 100% for business, I would be reimbursing miles so you don't have add backs and things like that. Section 162, business miles also hits on. 274, which is your logs. And then you have something else. You have luxury auto limits if you're trying to write off a car. 280F. Right, things that you need to do. You got to always keep a contemporaneous mileage log. Use one of the apps out there like MileIQ. Will track it. And then you deduct miles between your business locations or from a qualified home office to go visit clients. And you use the standard mileage method. If you're using your vehicle a lot, and this is something I'd talk with your accountant on, you might go to the actual. You have to choose either I'm using standard mileage or I'm doing the actual expense methodology. You can't do both. So there's no double dipping. But if, just kind of an underlying thing, that home office can make a big difference if you're trying to make sure your expenses are travel related, travel business related, I should say. All right, number 8. Personal legal accounting through the corporation. This is where we get into some weird stuff, right? If my S Corp pays my personal attorney, it's deductible. That is not a thing, right? The reality is it's usually a constructive dividend, distribution, or wages. It is not a business deduction. What are the code receipts to back this up? 162, 262, constructive dividends is 301 and 311, I believe. And what's the fix? If you have business counsel, that's tracked on your business. If you have personal counsel, it's personal. There are no deductions. And we see this all the time because we see folks who will come here, they'll do a corporation, sometimes they'll do a living trust, things like that. And they'll be like, oh, I'm just going to write it all off on the corporation. Does not work out that way. The corporation can be deducted. The living trust, no, because that's a personal expense. Now, can you allocate like full boat to the corporation and a partial to, in a reduced amount second entity to the living trust? Yes, under certain circumstances, but you do that with your accountant, right? You want to make sure that you are not just blindly saying, hey, if I just pay for my personal return through my business, somehow I don't have to pay tax on it. It doesn't work that way. Number 9, GoFundMes. These are big. We've had a lot of natural disasters and things like that. GoFundMes is not a charity, right? So the myth is, I donated in a GoFundMe and I write it off. No. Deductible gifts must be qualified under 170. It's organizations that meet the requirements under 501c3. GoFundMe is not that. You are gifting money. It is not deductible. So most person-to-person fundraisers are not deductible. What code provisions? 170, 170F8 if you want to really get into the substantiation requirements. So if you want to, this is the fix, give to recognized charities and keep the acknowledgement letter where they are writing to you saying, you did not get something in exchange for this, that we are a qualified 501c3. Go pull their letter from the IRS that says that they're a 501c3. They'll usually put it on their website, but they should write something back to you that says, or give it to your church, right? They'll usually issue you some sort of receipt. All right, let's go to number 10, which is the misuse of home office and 280A, and I'm gonna call it the Augusta rule. They're using it wrong. Now, here's a myth. I have a desk at home, therefore it's my home office. Another one is, I can rent my house to my sole proprietorship or my partnership. They don't work. So reality, for Schedule C filers, if you're a sole proprietor, that space must be used regularly and exclusively as your principal place of business or for meeting clients in order to even be a home office. We like to use a combination of administrative office for the home by using a corporation that is reimbursing you for the use of the home. If you have a Schedule E and you're like doing rental activity, we like to have that corporation in the mix. So it's actually reimbursing you as an accountable plan for the administrative use of that office. If you are using 288, for example, the Augusta rule, where we are reimbursing for the use, then it has to be an S Corp or a C Corp in order to utilize that. You can rent your house to your corporation, the S or a C, or I say corporation, but that means LLC taxed as an S Corp or taxed as a C Corp as well, and you can rent it up to 14 days, and you don't have to pay tax on that money. Now, here's an easy fix for either of these. Number one, if you have that S Corp or a C Corp, have an accountable plan and use it to actually reimburse for the use of that area. And this is where it gets really cool. Normally, you're doing this $5 a foot per year thing, which is kind of a safe harbor if you're a sole proprietor. Not so much. When I am doing a reimbursement under an accountable plan through an S or a C Corp, I can actually reimburse for the expense, everything from the utilities to the costs that are associated with that house, including even portion of depreciation. There's a calculation we do. We can pay that back. But you actually have to do it as a reimbursement. And here's the thing. If I don't reimburse, if I didn't make a payment, there is no deduction. If I didn't pay for the use of the home for the shareholder meeting or for the directors meeting, no deduction. It's not something that I can go back on. And we see this time and time again where people say, well, I was entitled to it, I just didn't do it. If you didn't do it, it's not a deduction. Now let's go to some rapid fire bonus questions that people, again, they're always trying to write stuff off. And some of these, you just go, really? Come on, guys. Every meal, including groceries, they're trying to write off. And they say, oh, you know, it's for my business. I'm using it for my business because I'm thinking about business or I'm reading or something like that. No. If you have a business meal, you're away from the office or you're entertaining somebody, it's part of a business meal, it's part of a profit incentive, you can write it off up to 50%. Groceries at home, never. How about penalties and tax payments? I want to write those off because it's a government fine or a penalty or income tax. No. 162, 164, business versus personal, can't do it. How about political donations, club dues? I want to join my country club. No, and still no, you can't do it. How about paying kids' spouse for fake work? No, I can't just decide I'm going to pay my kids. They actually have to do something and I have to document it. Must be legit work at reasonable compensation, which is all over the place, but it still has to be done. Like I would back these things up. There's a great case where somebody was paying, I think it was a 9-year-old child, but they were given Screen Actor Guild pay. And it went into the court case, that's how you know. And it's one of those things where you're looking at it saying, yeah, just because they're young doesn't mean that their time is worthless. It just means that you need to be able to back it up. And they were able to back it up, so they got the expense. Bonuses that are not through payroll or actually not paid. They're not deductible wages. You don't get to, say, hey, this was something that I paid. I could be looking at having penalties if I pay myself and I don't categorize it correctly. If I am a partnership and an S Corp, it's easy. I can take distributions. C Corp, a little bit harder. How about medical insurance, health insurance, things like that? Again, it depends on the type of entity you are, but if I am writing off or if I am taking insurance, health insurance through like an S corporation, that is actually taxable to me as a greater than 2% shareholder or as the owner, right? So that means I'm going to be writing it off on my 1040 as unreimbursed insurance expense. But if I'm just paying myself as an S Corp, a whole bunch of medical reimbursement, that is taxable to me. Other things I see, automobile repairs, car washes, things like that, gas when the title is not in the entity. You got to have the ownership, and you have to have business use, and you got to make sure you're tracking these things, and you can't be doing the reimbursement under those circumstances. Here's another one we see, which is education for a new trade. Like I'm writing off my college, I'm trying to do those things. It's not something I'm doing currently. That is not a business expense. When it is a business expense is when it maintains or improves current skills or is a requirement, like I'm an attorney, I have to do my continuing education, things like that. Other things we see that are not deductible, jewelry and appearance, we already kind of went over some of those, but if it is something that is suitable, I'm just going to say the jewelry one because it's never. Your appearance, almost never. The only exception for things like if you're wearing them is, again, safety gear, uniforms that are not suitable for street wear, or perhaps if you were a production company. Again, it's ordinary necessary for that trade or business. All right, so that's it. Enough dream killing today. What's your favorite expense that you heard somebody pitch and you're wondering if it's legit? Put it down in the comments below. Like, subscribe, and share this with anyone you think would benefit. Now, to make you feel better, go watch my million-plus viewed video called How to Pay Zero Taxes on Capital Gains. It'll make you feel much better because I'll show you what you can actually do, use to pay less in taxes. And I'll see you guys later.